Imagine the situation. You just bought a house in Bangalore, and instead of choosing to stay in it, you have chosen to lend it out for rent. Now, you feel as though that house is earning you income throughout the year while you sleep. Now that the tax season is here, you have to calculate the income you earn from it, report the income you earn from it, and possibly pay tax on the income you earned. Now, that is where the concept of income from house property comes in. And I, N.R. Chippen, I'm going to be taking you through the provisions under the Income Tax Act that relates to income from house property. Before going into the act and everything, let us first understand what is income from house property. It's the income that you generate by owning or letting out any building or piece of land attached to that building, and it is taxable under the head income from house property, which is one of the five heads of income under the Indian Income Tax Act. So it includes income from renting out buildings and lands attached to it, which may include parking spaces, etc., which is owned by a person. It applies to any residential, commercial, or industrial buildings. It could be houses, shops, factories, whatever. And only the owner or the deemed to be owner is taxed for the income earned through rent. The tenant doesn't need to pay any tax on the rental income. So the income from house property is governed from Section 22 to Section 27 of the Indian Income Tax Act. Section 22 talks about what is income from house property, right? Like I mentioned before, it's the tax that is charged on ownership or lending out of buildings and lands attached to it by of the owner. It's only for the owner's income. It is not subject to tax if the owner uses it for his own business. Section 23 talks about how you're going to calculate the annual value for of that building for tax purposes. Section 24 talks about the deductions which are allowed for this. There are two main deductions. One is a standard deduction, which is at 30% of the NAV, and then the other is the interest that you're paying on taking a loan to complete the construction of this building. So there are three types of house property. Number one is a self-occupied house property. This is where you own the house and you're staying in it. And for this house, there is no type of tax for a self-occupied property. Under this category, you can claim up to two homes as self-occupied. And if you're going to ask me what will happen from the third home, it will be deemed to be let out. That is, even though you're not, even if irrespective of whether you're letting it out for rent or not, it will be assumed that you have lent it out for rent and you will be taxed accordingly. And then the third type is let out property. This is where you just give it off to rent. All right. Now that we have had a basic understanding of what is income from house property, what are the different types of properties, and a few key sections, let us look at how we are going to calculate the taxable income from house property. So the first step in calculating this is to determine the gross annual value. So what the first thing you need to do here is compare the municipal rent value and fair rent value and take the higher of the two. Next up, you take the higher value of the previous two and then compare it with standard rent. And you take the lower of these two, and the value that you're getting is the expected rent. Now you compare the expected rent with the actual rent that you receive from the tenant and take the higher value. Now there may be a situation where the house has been vacant or not let out for a period of time, right? So in such a situation, that can be deducted from the gross annual value to give you an advantage. So if it is not rented out for like 2 months, then you can deduct the 2 months rent from the value, and then the final value that you are getting is the gross annual value. Step two is to detect municipal taxes that you have paid. So, what are these municipal taxes? They're nothing but payments or taxes that you have made to local authorities throughout the year. So, there's a provision that allows you to detect these taxes that you have paid from the gross annual value, and the value you get thereon is the net annual value. Now, once that you have obtained the NAV, you have to take care of the standard deduction, which comes under section 24. So, there is a 30% standard deduction from a NAV, irrespective of the expenditure that you've incurred or whatever it may be. Whatever your NAV value is, you can reduce 30% from it. Now, step 4 is to compute and deduct the interest on the home loan you have taken. Now, there are two key aspects here: pre-construction interest and current year interest. Right? That is the post-construction interest. So now how this works is pre-construction interest's time period is from the date of the loan you have taken to the previous financial year of where you have completed the construction. For example, let's say you have taken a loan on 1st April 2024 and you're completing the construction on 31st of October on 2025. Let's just take that as an example. The interest that you will calculate is only for the financial year 24-25. That is 1st April 2024 to 31st March 2025. The interest thereon will not be considered for pre-construction interest and will be taken for the constructed current year interest, right? So the pre-construction interest, whatever value it is, it cannot be detected together at a single time. You can make 5 equal deductions of it. For self-occupied properties, this deduction is capped at 2 lakhs per year. So for self-occupied properties, the pre-construction interest plus the current year interest for 1 year should be capped at 2 lakhs. It can't exceed that. Now let's talk about current year interest. So interest paid in the financial year after the construction or like in the financial year where construction is completed is fully deductible if the property is lent out for rent. For again, like I mentioned before, for self-occupied properties, the sum of current year interest plus pre-construction interest should be not less than 2 lakhs per annum. And then finally, the last step is subtracting the standard deduction and interest on home loan from the net annual value. The resulting value is your taxable income or loss that you have gained. Now that we have understood how to calculate the taxable income from house property, let us take an example and see. So here is the example. So Gopal is a house owner and he has a house which contains of 3 independent units. Ground floor is 40% is equal to 40% of the value. First floor is again equal to 40% of the value. And the second floor is equal to 20%. Now the ground floor is self-occupied by Gopal and the first and second floor is given for rent. So the municipal rental value is 1 lakh, fair rental value is 90,000 per annum, standard value is 80,000. There is a municipal tax is at 10% of MRV. Repair expenditure is 10,000 per annum. The rent for ground floor is 5,000 per annum. Actual rent for first floor is 5,000 per month. The rent for the second floor is 2,000 per month. And then the first floor remained vacant for 2 months. And Gopal has also taken a loan for 7 lakhs at 10% interest rate on 1st July 2021. And the house was completed on 15th July 2023. Now, Gopal has returned a loan of 1,40,000 on 31st March 2024. Now, we will look at how we're going to calculate the taxable income under house property under the old tax regime. So, like I said before, the first step is to calculate the gross annual value. So, for that, you have to compare the MRV and FRV first. So, before going into that, here I have split it into 3 parts. So, the first is will show you the full value, and then the third part will show you the ground floor, which is 40%, first floor, which is another 40%, and second floor, which is the 20%. So self-occupied property, like I mentioned before, has no tax. So there is no point in calculating the net annual value. However, you can have deductions under the self-occupied property as well. So we'll just take that into calculation. And till NAV, we can ignore the ground floor because it's self-occupied. So here we have MRV, you have to compare MRV and FRV first. So MRV is a total of 1 lakh and for first floor will be 40,000 and second floor will be 20,000 because we have to apportion it according to the total percentage of value it holds. FRB is in a total of 90,000. So for first floor will be 36,000 and then for second floor will be 20,000. And we have to take whatever is higher, right? So we'll be taking the MRV itself. So in total it will be 1 lakh. For the first floor will be 40,000 and for the second floor it will be 20,000. Next, we have to compare the obtained result with the standard rent, which is at 80,000. So again, you have to apportion the standard rent accordingly. So for the first floor, it will be 32,000, and for the second floor, it will be 16,000. And here, we have to take whichever is less. So here, we'll be actually taking the standard rent. So in total, it will be 80,000, and for the first floor, it will be 32,000, and for the second floor, it will be 16,000. Now that we've gotten the expected rent, we have to compare it with the actual rent. Now, in the question itself, it has been given to us that the rent for first floor is 5,000 per month or 60,000 per annum. And for the second floor, it's 2,000 per month or 24,000 per annum that we have taken here. Now, out of this, out of the expected rent and the actual rent, we have to take whichever is higher. So, as actual rent is higher here, we'll take that. So, for the first floor, will be 60,000 and for the second floor, will be 24,000. Now, again, here in the question, it has been told that the first floor has remained vacant for 2 months. So, we have a provision which allows us to reduce the loss from that while calculating the gross annual value. So our actual loss will be 2 months rent, which will be 2 into 5,000, 10,000, which we can reduce for the first floor. So that's what's given here. Loss due to vacancy, it's reduced 10,000 per first floor. So the gross annual value for the first floor will be 50,000 and for the second floor it will be 24,000. Now that the first step is done, let's move on to the second step, which is to reduce the municipal taxes we have paid. In the question itself, it was given that municipal taxes is 10% of MRV. So here MRV for the first floor is 40,000 and for the second floor is 20,000. So we'll reduce 4,000 and 2,000 accordingly, which is 10% of the MRV. Now that we have found out what the municipal tax is, we can do GAV minus municipal taxes to get the NAV. So for the first floor, it will be 46,000 and for the second floor, it will be 22,000. Now, which we go on to the fourth step, which is reducing standard deduction. So standard deduction is always taken at 30% of the NAV. So for the first floor, 30% will be 13,800 and for the second floor, it will be 6,600. And then we can reduce the pre-construction interest after that, which will be the next step. So here it is mentioned that Gopal took a loan of 7 lakhs at 10% on 1st July and the house was completed on 15th July 2023. So we only have to, the pre-construction interest will only be from 1st July 2021 to 31st March 2023. So for the first year, it will only be for 9 months, which will be 52,500. And for the second year, it will be 70,000. So in a total of 122,500. And we can deduct that in 5 equal installments. So one installment will be for 24,500. And again, it needs to be apportioned according to the proportions. Right. So for the ground floor, we can reduce 9,800. For the first floor, again, we can reduce 9,800. And for the second floor, we can reduce 4,900. Now, we have to reduce the current year interest of the house loan is taken. So here it is given that on 31st March 2024, Gopal has repaid a loan of 1,40,000. So the outstanding loan here is only 5,60,000 and 10% on that is 56,000. That will be the current year interest. Again, apportioning it proportionally, it will be 22,400 for the ground and first floors and 11,200 for the second floor. Now that we have finished with everything, we can finally calculate our income or loss from our house property. So, since the ground floor is self-occupied, there will be no NAV and only detection, so it will result in a loss. It results in a loss of 32,200. If you see for the first floor, the NAV and the detections balance each other out, so it results in a zero value. And for the second floor, we have a loss of 700. Now, this 40-40-20 split is actually it's a good split if you're going to be building your house and doing it because you actually don't have to pay any tax on this. You'll only be getting a loss from your house property, at least right? You don't have to pay any tax from it. So here the total loss will be 32,900. Now that we know we have a loss, now what do we do with that loss? Is there any provision where we can reduce that loss from other income or carry forward? That is what you're going to look at. So here it varies from old regime and new regime. So under the old tax regime, you can reduce the losses, you can offset the losses from house property from any other income heads like salary or profits and gains from businesses, etc., etc. But it's capped at 2 lakhs per annum. You can't exceed that amount. So, but if you have, let's say you have a loss of 3 lakhs or something, what do you do then? In your first year, you can set of 2 lakhs, and then you can carry forward that 1 lakh for up to 8 assessment years immediately following the year in which the loss was incurred. Right? But when you carry forward, the carried forward loss can only be adjusted against income from house property. So it can only be an intra-head adjustment. You can't use the carried forward losses to reduce income from other sources like salary or profits from gains in businesses like that. Under the new tax regime, there is no provision where you can set off the losses against other income or carry forward your loss to future years. The new tax regime doesn't allow that. And with that, we come to the end of this presentation. I hope it was clear to all of you, and thank you for listening.